Nike's latest results were so out of character that it had many investors talking about Nike stock, asking what's going on, why are revenues down, what is the company doing to reverse those trends, did they make mistakes that they cannot reverse anymore, is competition becoming too powerful and Nike falling behind. All of those reasons has investors curious about Nike stock, asking if the stock price decline is a buying opportunity or if they should stay away from Nike stock. Regardless, Nike has encouraged a lot of curiosity from investors. And so in this video, I'm going to share a little bit about Nike's latest results to answer some questions that investors may have had about Nike and its latest performance.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So first of all, Nike's revenue from new footwear products were up strong double digits versus the last year. And this includes multiple franchises that have scaled quickly based on unit growth over the past 12 months. And this was one of the big themes in Nike's latest earnings call is the focus on new products. They told investors that they had been over-relying on past franchises that were proven successful. And so they were just relying on those franchises that they can count on to drive revenue and drive profitability. And they hadn't been investing enough in new products, in new categories to drive incremental revenue growth and increased interest from customers and not oversaturate those franchises that had a sort of scarcity value because they would be released in limited quantities and customers had to wait for new colors to come out. And so that created a buzz around those brands. But since Nike had been relying on them so frequently, that saturated that market. And so now Nike's telling investors, look, we've got some new footwear products that's really driving growth. And we're optimistic about these products based on what we've seen so far. As they go into the spring season, Nike expects contribution from newness and innovation will take a significant step forward with growth in footwear units in mid to high single digits versus the last year. And over coming seasons, they expect sequential gains in the percentage of newness and innovation as a mix of their total footwear business. Again, reiterating that focus I highlighted earlier with new, investing in research and development, getting the research and development to produce new products, new shoes that drive consumer interest and that drive unit growth, because now these new products will encourage consumers to maybe visit that shoe store, try on some shoes and pick one of them to buy. And Nike needed this because in the first quarter, their revenue declined 10% year over year. Usually Nike's revenue is reversed. Usually Nike grows its revenue roughly 10% year over year. That's been the average over the last decade. Is Nike's growth is around 8% year over year annually over the last decade. And so for Nike to deliver these types of revenue declines was startling to investors. And that had a lot of investors really curious about what's going on inside of Nike, what's driving these declines. And partly it's Nike Direct, which is down 12%. Nike Direct includes Nike's app and website and its physical stores that are Nike branded. So not third-party sales, just Nike. And that was a strategy that the outgoing CEO really emphasized, was focusing on Nike Direct, because those revenues come with higher profit margins compared to revenues to wholesalers, which come at lower profit margins because you're selling at lower average selling prices. And so this was the strategy of the outgoing CEO. Focus more on direct. It delivers higher profit margins. It also provides us a deeper connection with our customers because they're buying directly from us. So we get to manage the whole experience between us and the consumer, collect more data, and learn how to better serve customers in that way. However, that strategy has backfired, and I wouldn't be surprised if that lack of success with that strategy is the reason why the former CEO is becoming the outgoing CEO, being replaced by Elliott Hill. Now, It has had the impact of increasing gross profit margins, which again increased in the latest quarter by 120 basis points to 45%. So at least that part of the strategy did work. They did generate higher profit margins, but it's coming at the expense of smaller revenue and lower unit sales. And this is primarily due to the recent increase in gross profit margin is due to lower Nike brand product costs. As the cost of inflation has slowed, the rate of inflation has reversed. And so that's benefited Nike. They've also had lower warehousing and logistics costs and benefits from strategic pricing actions last year. They've raised a lot of prices, and they've been raising prices significantly over the last 5 years, over the last 10 years. If you've been a Nike customer, you've noticed the increasing prices of many of their products over the last decade. Now, coupled with those increasing prices, they've also had more promotional activity. I haven't seen this type of promotional activity from Nike in a long time. Coupled with this Nike Direct strategy, they've also increased promotional activity. You can find a $200 shoe sometimes selling for $50 on Nike's website. And they're able to do that because they can offer, let's say, 6 different colors of that same shoe. And they'll notice that one of those colors they produce too many of, that it's not selling as well as they thought. And so they can offer a targeted promotion for that one color of that one shoe and lower the price and drive sales because they have the website and they collect the data and they can target those promotions to customers on that one specific product. And they have been doing that. And that's one of the reasons why they were initiating this strategy to begin with. So I like what they did with the SG&A expenses, which declined by 2% overall. But within SG&A, which stands for Selling, General, and Administrative Expenses, they actually accelerated investment in demand creation, which is advertising. But this was more than offset by the reduction in overhead expenses. And if you've been following my channel, you know I'm against overhead expense. I'm against these general and administrative expenses that I feel are wasteful, and I feel companies' management teams sometimes overdo these things. These are expenses on things like corporate headquarters, the furniture for the CEO's office, the spending on the annual Christmas party, travel expenses for management, etc., etc. These are things that I feel sometimes are overdone and are wasteful if you're an owner and you're entrusting a company's management team to be prudent with expense management. I feel this can be a little bit of a area where investors get, conflict of interest, right? If you're the CEO of a company and you have an expense account and you're deciding where to go out for lunch, and you know it's going to be on the company's tab, you're not going to pay for it personally, it's going to be on the company's expense, you're not going to look to the price of that dinner or the price of that lunch when you're making the decision. You're just going to choose whatever's the best thing that you're wanting to have for lunch or dinner. And that can be, a dinner that costs the company $300 instead of, if you was your own personal money, would you spend $300 on a dinner every single day of the week, right? So those are some areas where managements can have this sort of conflict of interest with shareholders. And so I like to see when companies are decreasing this general and administrative expense line item, because that means the wastefulness is decreasing somewhat. I know there's still some wastefulness in there, but at least it's decreasing. So they go on to say that Q1 revenue in Greater China was down 3%. Nike Direct in Greater China actually declined 16%, and Nike Digital was down 34%. Surprisingly, wholesale grew 10%. Nike saying that this summer retail sales moderated across the industry in China, and Nike was not immune as traffic decelerated in their channels with lower sell-through rates. And this has resulted in elevated inventory in the marketplace in an already promotional environment. And we've been getting several data points about the Chinese economy and how it's growing very slowly, or if at all. And the Chinese government stepped in to provide some stimulus, and it remains to be seen if that stimulus will be enough to revive the economy there. And I've seen this from companies like Nike, Starbucks, Alibaba, Apple, etc., etc. You can hear company management teams talking about how soft the Chinese economy has been in 2024. And I'll end with Nike's outlook for the near term, which they say has moderated, but they remain optimistic about their long-term opportunities for sport and Nike in China. Overall, they expect second quarter revenues to be down again, close to 10%, and they expect second quarter gross margins to be down 150 basis points because they feel they're going to need to do more promotions, and there's going to be more headwinds, and supply chains are going to deleverage because unit sales are going to be down, and that's going to offset the fact that they're going to have lower product cost and a decreasing benefit from strategic pricing actions. So the headwinds are expected to continue for Nike, and management saying don't expect things to improve, at least not in the next 3 months. But longer term, they're saying they remain very optimistic overall, and in the business in China specifically, they remain optimistic about the long term. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.